Alright, guys, here we go. Alright. So, it's a Sunday night, February 15th, 2026. The Saas stocks have been taking a major hit lately. And I think today what we're going to do is just kind of go through several of them, look at their numbers, maybe read some articles about why they are dropping, see if we can find any inside information. We'll run through the major indices real quick. Dow Jones is sitting at 49,590.93 points. It's below 50,000. We can complain about the powers that be doing what they do. S&P 500 is at 6,836.17. The NASDAQ is at 22,546. The Russell's at 2,646.7. Bitcoin's currently at 68,854. Oh, $68,726.98. The Qs are at 601.92. Ethereum sitting at $1,974.50. It's up. No, it's down. I'm tripping. It's down 5.32% on the day. XRP's at $1.48. It's down $1.70. No, it's down 1.73% on the day. All right. Dang it. 1 second. Okie dokie, here we go. Consult the notes. I've got some extensive notes over here, guys. Before we get into this, remember this is not financial advice. I am literally a guy going crazy in his side room. This is nothing more than entertainment and fun and all that. That being said, let's get into it. Let's consult the notes. Let's try Shopify. Okay. Shop. Okay, we've got Shopify on the screen. I'm going to take a moment to get this stuff pulled up on my phone so I can do this all properly. And we'll get it poppin'. Get it poppin'. Cain Velasquez has been released from prison. We got the Epstein files out. It's going down, guys. It's going down, guys. Everything we ever wanted is coming to fruition. The prophecies are being fulfilled. Seriously. In my own life. Okay. We're halfway there. We are Seriously. Okay. Alright, we've done it. We're live. Here we go, baby. What the whistle before we start reading all this crap. So, let's start with the question. Do we think that the AI emergence is going to destroy all these SaaS companies? These companies like Netflix, Shopify, Adobe. We've got a Monday.com that we're going to take a look at. We've got HubSpot. All this different stuff. Yeah, Salesforce. All, these stocks I don't think are going to be as affected by the AI play as some people imagine. I guess some people think that you can just take AI and like make one of these apps, like make a Netflix or make a Shopify with AI. And I guess maybe in some like vague technical way you can, but these companies require like tons of people, a building, lots of money to get started. Like if you just introduced a like made an app on your with your AI that did the same thing Netflix did, who are you going to get to buy it? You know what I mean? Netflix is already popular. This is just some of the questions that like start to pop into my mind when I think about this. It's like, I mean, maybe someday you can create your own Shopify app or something like that, but that's not right now. I mean, and who's to say that Shopify doesn't use AI to make its own app more powerful or whatever, It's just a lot of it's a lot of baloney, a lot of silly stuff going on with this, in my personal opinion. I don't think I'm invested in any of these except maybe like I don't know, maybe like Shopify or something like that. I think I have like one share of it or something crazy. But I don't have any like this stuff doesn't really make any personal difference to me, you know what I mean? Like I just want to figure it out so that I understand what's going on in the markets better. That's where I'm at with it. So we've got Shopify here. And guys, if anybody ever watches this, leave a comment of a stock that you might want me to investigate, and I'll do a dive into it. That's kind of something that I like to do. Dive into these individual stocks, read up as much as I can about an individual stock, see if I can get a better understanding of it, It's fun to me. I like doing it. So, here we go. Shopify. On a one-day chart, remember this is the weekend, so weekend after hours trading, it's sitting at $112.44. Okay? On a 5-day chart, it's down 8.5%. On a 1-month chart, it's down 28.67%. On a 6-month chart, it's down 20.34%. Year to date, it is down 29.99%. On a 1-year chart, Shopify is down 12.85%. On a 5-year chart, it's down 21.46%. There's a maximum from maximum chart from Google Finance goes back to May 22nd, 2015. And it's up. It's up 3,882.33% since then. Pretty neat. Okay. So we're just gonna read some of its we'll read its top headlines here. So perspectives from across the web. Shopify declined over 32% in the past month as strong Q4 results and robust Q1 revenue guidance were offset by free cash flow margin pressure and a general software stock sell-off. Analysts project continued strong revenue growth in the low 30s percentage rate for Q1, but margin durability remains a watch point. Okay. All right. So, the bullish view. $2 billion share repurchase program. Shopify's board authorized a significant share buyback program to reduce its equity base, aiming to increase EPS and ROE. This move is intended to help lift investor sentiment amidst recent volatility. Strong revenue growth in Q1 guidance. The company reported Q4 2025 revenue of over $3.6 billion, beating estimates and forecast Q1 2026 revenue to grow at a low 30s percentage year over year, which is above the prior consensus estimate of about 25%. AI innovation and leadership. Shopify is investing heavily in AI tools like Sidekick and agentic storefronts, with orders coming from AI searches increasing 15-fold. Analysts believe this positions this company as a category leader in e-commerce innovation. All right. Let's read the bearish side. Come on now. Bearish view. Free cash flow margin. Despite strong top-line growth, management guided free cash flow margins in the low to mid-teens for Q1 2026, a decrease from Q1 2025. This focus on near-term investment is pressuring margins. Analyst price target reductions. While the overall consensus remains a moderate buy, some firms like Stifel and Truist Securities recently lowered their price targets due to valuation concerns and margin pressures, despite acknowledging strong fundamentals. Insider selling activity. Several senior officers and directors, including the CFO and president, have engaged in multiple share sales in early 2026, which may signal caution to investors. All right. Let's read a few of their stats here. Shopify's 52-week highs at $182.19, 52-week low of $69.84. It has an EPS of 94 cents, and it has a PE ratio of 119.47. About 8,000 employees. 1.22 billion shares outstanding. All right. Okay. So let's pull up a different stock. Let's do, I think we're going to do about 5 of these. Yeah, I think we're going to do about 5 of these individual stocks and then maybe read a couple articles. Let's try HubSpot. I have never heard of that, so. All right. So we got HubSpot Incorporated. HUBS ticker symbol. It's sitting at $245 on Sunday evening. On a 5-day chart, it's up 3.93%. On a 1-month chart, it's down 25.94%. On a 6-month chart, it's down 44.5%. Year to date, it's down 39.23%. On a 1-year chart, HubSpot is down 69.65%. On a 5-year chart, it's down 55.13%. And on a maximum chart, it's up. Let's see how far it goes back. It goes back to December 5th, 2014. It's up 739.41% all time. Let's read some of its stats. I got a PE ratio of 282.53, 52-week high of $820, a 52-week low of 207.20, so it's much closer to its 52-week low, an EPS of 0.86. HubSpot. All right, let's read its headlines here. Perspectives from across the web. This is a conglomerate of kind of views from 17 sites, they say here. Google Finance, their headlines. You get it. HubSpot declined approximately 29% in the past month, driven by scrapped acquisition talks and analyst price target cuts. However, strong Q4 earnings and bullish 2026 guidance act as catalyst. Sentiment suggests potential recovery, with analysts projecting significant upside over the next quarter. Okay, bullish view. Strong earnings beat and bullish guidance. Okay. HubSpot reported Q4 earnings and revenue that exceeded analyst expectations. Its fiscal 2026 EPS and revenue guidance also surpassed consensus forecasts, signaling strong underlying business momentum despite market pressures. Reported Q4 earnings and revenue that exceeded analyst expectations. Its fiscal 2026 EPS and revenue guidance also surpassed consensus forecasts. Okay. Expansion via Breeze AI ecosystem. The company's new AI platform and Breeze agents are significant growth drivers with one agent autonomously resolving over 50% of support tickets. This technological shift attracts larger enterprise clients and positions HubSpot as an AI innovator. $1 billion share repurchase program. HubSpot's management authorized a share buyback program of up to $1 billion. This move indicates confidence in the company's valuation and future prospects, potentially boosting investor sentiment and providing technical support. All right. Let's read the bearish view. Google acquisition talks scrapped. Reports that Google parent Alphabet is no longer pursuing an acquisition caused the stock to tumble around 12%. The failure of the potential deal removed a major upside catalyst for the share price. Widespread analyst price targets. Cuts. Despite strong earnings, several analysts from firms like Truist and BMO Capital significantly lowered their price targets, citing concerns over slowing industry growth and software multiples, reflecting a cautious market tone. Insider selling activity. Certain insiders, including a director and an insider named Erica Ashley Fisher, have sold a notable amount of company shares in the last quarter, which may be perceived negatively by investors. I think it's kind of weird that they name them like that. It's kind of funny. Kind of strange. Yeah, that's really weird, actually. I wish I had done this with Shopify. Maybe we'll go back and do it. Look at their earnings. So they beat by 3.41. This is HubSpot we're talking about here. HubSpot beat on earnings back on February 11th. They beat the 2.99 estimated earnings. They beat it and got 3.09 EPS. They beat by 1.92% on revenue as well. Yeah, that's what we're going to look at Shopify's earnings too. We'll just pull it up on another. My dogs are in there wrestling. I can hear them. So, in comparison, we have Shopify here. They reported on February 11th as well, and they missed EPS by 5.71%. They were estimated at 0.51. They got 0.48. They beat on revenue by 2.25%. Getting ahead of myself. Yeah, they beat on revenue, but they missed by 5.71% on EPS. And plus, HubSpot's EPS is higher. So, now, HubSpot has a PE ratio of 282. Keep that in my head. And we got Shopify's PE ratios at 119.47. Just comparing the two here. Shopify's more, it's like in the middle range of its 52-week range. And our friend HubSpot is much closer to its 52-week low. Not saying, go buy one or the other. I wouldn't. That whole extreme PE ratio kind of. See, that's. What's up with that? We're going to look at a few more. Let's try. Let's try Adobe. All right, here we go. Put my mouth where your money is. Let's go, baby. We got Adobe. All right, so we got Adobe here. ADBE is the ticker symbol. Right here on a Sunday evening, it's sitting at $263.94 a share. On a 5-day chart, it's down 1.26%. On a 1-month chart, it's down 13.19%. On a 6-month chart, it's down 25.61%. On a year-to-date chart, it's down 24.56%. On a 1-year chart, it's down 43.12%. On a 5-year chart, it's down 44.91%. Whoa. On a maximum chart, it's up 119,886.36%. I said dollars. 119,886.36%. There we go. The heck are them dogs in there doing? Something crazy, I'm sure. Now this is Adobe. We just looked at Shopify, we looked at HubSpot, and we looked at Adobe. Now we're looking at Adobe. Okay. Here we go, guys. Now we're getting somewhere. Adobe, their 52-week high is $464.99. Where are they at right now? I forgot. $263.95 or something like that. Their 52-week low is $251.10. EPS is $16.70. Adobe's PE ratio is 15.81 as compared to the two that we just saw, which were 100 and something and 200 and something respectively. I can't remember. 31,000 employees. 410.5 million shares. Okay. Alright. So, very interesting. What the heck? EPS $16.70. 410.5 million shares outstanding. PE ratio of 15.81. Where? Alright. We'll go through their earnings. They reported on December 10th, 2025. They beat on EPS by 1.9%. They were estimated to get 5.4, and they got 5.5. Cool. Revenue beat by 1.36%. They were estimated to get 6.11 billion. They got 6.19 billion. Solid. We'll look at their what about that? There we go. All right, let's read the perspectives from Google Finance. Perspectives from across the web. Adobe declined over the past 15 months, driven by what am I even reading? Adobe declined over the past month, driven by AI competition and a stretched valuation. The Q4 earnings beat and strong Q1 guidance provided limited upward momentum. Analysts project an average target price significantly above current trading levels, suggesting a potential rebound in the next quarter. All right. The bullish view. Strong Q4 performance and Q1 guidance beat. Adobe's Q4 non-GAAP EPS and revenue exceeded analyst expectations. Furthermore, Q1 FY 2026 revenue and EPS guidance were both better than consensus estimates, indicating continued operational strength. Analyst consensus and price targets. Wall Street analysts hold a buy or hold consensus with an average price target of approximately $428.08, implying a significant upside of over 60% from the current price. All right. That's Adobe we're talking about here, guys. AI innovation and open ecosystem. Adobe is leveraging AI with its Firefly models and is pivoting towards an open AI ecosystem, which is expected to drive annualized recurring revenue growth in fiscal year 2026. Stiff competition in the AI space. The company faces significant competition in AI from Microsoft, Alphabet, OpenAI, and others, leading to market apprehension about the long-term impact on its business model. High valuation concerns. Adobe's PE and price-to-book ratios are significantly higher than those of its industry peers, suggesting a stretched valuation despite its recent performance. Recent insider selling activity. Insider selling activity has been observed in the last 90 days, with the CFO selling shares in late January 2026, which can be interpreted as a bearish signal. All right, let's do one more. Then I think we're going to come back and read this article. I might do that. We'll do the two more. We'll do the two more stocks. And then we'll come back and read that article. I want to do Salesforce as well. All right. Ticker symbol CRM, Salesforce. On Sunday evening right now, it's sitting at 189.80. On a 5-day chart, it's down 2.4%. 2.4%. On a 1-month chart, it's down 18.76%. 6 months, it's down 21.75%. Year to date, it's down 28.38%. On a 1-year chart, Salesforce is down 42.33%. 5-year chart, it's down 23.5%. On a maximum chart that goes back to June 25th, 2004, it's up 4,703.04%. Salesforce. Let's have a look at their stats. Of the 4 we've read so far, it's the only one that pays a dividend, so that's kind of pretty cool. We love that. Pay you just to have it, huh? All right. So Salesforce's 52-week high is $329.74. 52-week low is $180.24. $180.24. It pays a 0.88% dividend of 42 cents every 3 months. EPS of $7.50 and a PE ratio of 25.29. So that's about double of Adobe's. A little more than double of Adobe's and significantly less than the other two. So Excuse my dogs, guys. I got two pit bulls. They're in there battling right now. I'm trying to pause for a second. Yeah, if you ever hear a noise in the background that sounds like dogs fighting, they're not really fighting. They're just playing, but to the outside observer, you know. Just kind of some, we got Nvidia's sitting at 182.78 right now. Microsoft's sitting at 401.32. I find that interesting that Nvidia can't really break loose of its chains that are binding it. Back to business, back to business. Get back to business, guys. Alright. We're looking at Salesforce here. We're looking at Salesforce. Let's look at our earnings. Okay, so their earnings are to come up. Can I look at the... Well, alright. Yeah, so I guess we can't see their actual earnings yet because they haven't announced it yet. It'll be in 10 days on February 25th. That's cool. I guess that's okay. Alright. Now I'm getting hoarse. Oh, it's damn reading. There we go. Perspectives from across the web. This is Google Finance's little overview. Salesforce declined over 16% in the past month due to broad AI disruption, concerns, and leadership changes. Sentiment suggests a potential recovery as analysts project significant upside with an average price target over $320 for the next quarter. Bullish view. Strong analyst consensus. Analysts maintain a buy consensus rating for the stock, with an average price target suggesting a potential upside of approximately 70% from its current price. That'd be pretty cool, huh? Strategic AI acquisitions and partnerships. Salesforce acquired AI firm Simulate. I don't know how you say that. And expanded its partnership with NICE for AI-powered solutions, a strategic move to strengthen its AI-native offerings and drive future growth. Attractive valuation and high margins. The recent stock decline has led to a more attractive forward PE ratio compared to peers. The company maintains high gross margins and strong cash flow, indicating robust underlying financial health. Right? Let's check out the bearish view. Alright, let's check out the bearish view. Recent stock price decline and volatility. The company's stock has seen a significant decline of over 16% in the last 30 days, reflecting high volatility and investor uncertainty amidst the broader AI-driven market sell-off. AI competition and disruption concerns. The rise of AI is viewed by some as a potential threat to Salesforce's existing business model. The new AI native competitors are launching solutions that could pressure fees and market share. Leadership changes and cost cuts. Salesforce is undertaking a significant leadership reshuffling and job cuts to align resources with AI priorities, which is viewed as a near-term risk and reflects investor pressure on margins. Alright. It's the only one that pays a dividend so far. It's got the second lowest PE ratio. It's down near its 52-week low. Compared to its peers, its PE ratio is freaking so low. Nice EPS as well compared to the others. Adobe's is much higher, nearly double and half. So, let's do one more. That was Salesforce. I don't even know. I've never even heard of this, but we're going to try it. Monday.com. Have anybody heard of this? I just looked up some Saas stocks, some unusual ones earlier, and this was something they came up with, so. This is not financial advice. We are only here in the back room going wild, looking at stocks, guys, looking at the markets, trying to figure it out together. Teamwork makes the dream work. Like and subscribe, guys. That's what I need. That's what Daddy needs. Well, your cousin, technically. So, we got Monday.com here. Okay. Monday.com on Sunday evening is sitting at $72.55 a share. On a 5-day chart, it's down 3.69%. On a 1-month chart, it's down 45.5%. On a 6-month chart, it's down 58.81%. Year to date, it's down 50.95%. On a 1-year chart, it's down 77.52%. On a 5-year chart, it's down 61.77%. And on a maximum chart, it's down, which it only goes back to June 11th, 2021. It's down to 116.93%. That's Monday.com. Okay. Full disclosure, this was suggested to me by Gemini. This Monday.com said it's in the same sector as the other stocks. So I just wanted to have kind of a one that I hadn't heard of before. And this is one of those. Alright. I'll read its stats first. So Monday.com is, its 52-week high is $323.72. 52-week low of $68.68, an EPS of $2.24, and a PE ratio of 32.36, sitting it right directly in the middle of all the other ones with its PE ratio there. So that's kind of fun. And where is it on its 52-week high range? Let me see here. I forget. It's down low. It's pretty low. Yeah, it's very close to its 52-week low. Cool. Very interesting. All right. Perspectives from across the web. We've got Monday.com declined significantly in the past month they all declined significantly in the past month due to cautious forward guidance on revenue and margins for Q1 and full year 2026. This has triggered analyst downgrades and price target cuts. Sentiment suggests continued pressure, though analysts project potential long-term value from AI initiatives and deep undervaluation. Strong Q4 financial performance. The company reported Q4 2025 results that beat Wall Street estimates on both revenue and non-GAAP EPS, demonstrating solid current execution and operational discipline. Undervalued stock valuations following the recent sell-off, various valuation models suggesting the stock is significantly undervalued, with some estimates indicating an undervaluation of over 50% from its intrinsic value. Institutional accumulation. Institutions own over 70% of the stock and have been net buyers over the past quarters, with a significant increase in the buy-to-sell ratio recently potentially limiting further downside risk. So that institutional buying creates a floor that makes it hard for it to go down much further. Well, I mean, it's already, PE ratio is already down there at 32. It's like, without the company going out of business, how much further can it go? Same with like Adobe and Salesforce there. How low can they go? How low can you go? For real though. I mean, how low can it freaking go? It's crazy. It's crazy. The bearish view. Week forward guidance. Monday.com provided Q1 and full year 2026 revenue guidance that fell below analyst consensus estimates, signaling slowing growth and leading to a sharp share price decline. Analyst downgrades and price target cuts. Multiple analyst firms, including Baird and Loop Capital, downgraded the stock and significantly reduced their price targets due to the weak outlook and increased competitive pressures. The company faces a crowded software market with increasing AI competition and softer demand from small and medium businesses, which is pressuring future margins and growth. Alright, let's peep the earnings. Look at that. They beat by 13.21% on EPS. Estimated at 0.92 and they got 1.04. They beat by 1.28% on revenue. Estimated at $329.66 million. They got $333.88 million. Back on February 9th. That's Monday.com. Very interesting stuff, guys. All right. So what it's looking like to me is maybe Salesforce and Monday.com, their business models are like They seem like they're the two that are like the least investing into AI in like a very crazy way. Like the other ones are seeming to like really be AI oriented in a way, I guess, is from what I'm reading. Maybe. I could be wrong on this. I don't know. It's kind of just what I'm forming in my head here. Adobe seems like the most well positioned one to me. I think that's kind of becoming obvious. Here we go. We'll read this. So I think that's going to be enough of the individual stocks and charts. We'll do a couple articles here, if it'll let us. Okay. So we got Software Bear Market by The Motley Fool. Software Bear Market, 2 stocks with massive upside, according to Wall Street. And we can assume these are going to be in this article. This is Brett Schaefer at The Motley Fool on Sunday, February 15th, about 2:35 p.m. The latest narrative in the financial world is the risk that artificial intelligence will disrupt existing software businesses, with new tools emerging from heavily funded AI labs that allow developers to quickly code new projects with only natural language prompts. Shareholders have become concerned that competition will pop up everywhere and erode existing products or profits for software providers. This guy talking, the article. I believe this threat is overrated, presenting investors with a nice opportunity to buy high-quality software businesses at a reasonable price. Here are 2 software stocks with massive upside coming out of this software bear market, according to Wall Street. Where to invest $1,000 right now. Oh, this is something else. Sorry. My bad. Wix's accelerating growth. Wix.com. Wix. That's kind of cool. We didn't cover that one. Look at that. Is a website development platform that lets individuals or teams easily build websites without code. It has been thrown out with the software bathwater down to close to 70% in the last year. It makes little sense to sell Wix over low-code software development, as the company has been enabling individuals to do just that for building websites for a decade. Wall Street currently has an average price target of $151 for the stock compared to its current trading price of $72. So I'll say that. It seems like a bunch of these got like washed into a bucket of these are all the same kind of thing. And they all just kind of went down. Like the broader market was like, no, we don't want to deal with them because they're these type of stocks. You know what I mean? But really, they're all kind of doing a little bit of different stuff. Like Adobe doesn't do exactly what Monday.com does, and Wix does something different. You see what I'm saying? Salesforce is different from, the other one. Shopify. So here we go. Wix is accelerating growth. Wix.com is a website developed platform that... Did we just read that? Yeah, we just read that. Sorry. In fact, new AI tools that Wix is developing to help further improve its website development platform should increase its addressable market. We are already seeing this in the numbers. Revenue growth accelerated to 14% last quarter, up from 13% in the quarter a year ago. It is not a huge selection, but it clearly shows that AI tools are not killing Wix's website development and growth engine. The company has also acquired startup Base 44, Base 44, which helps users build mobile apps without coding. This fits perfectly alongside Wix's low-code website building platform. Base 44 had virtually zero revenue when it was acquired last fall, but was already on pace to hit $50 million in annual recurring revenue by the end of 2025. That is some phenomenal growth that should carry forward into 2026. Wix's free cash flow was $570 million over the last 12 months. The market cap is currently under $4 billion. This is a fantastic opportunity for investors to buy a durable growth stock at a dirt cheap price. That's according to this guy, not according to your cousin Dustin. I don't know nothing about this Wix. Adobe. Here we go. Adobe's cheap stock price. We covered Adobe, but we'll see what he says about it. Ticker symbol ADBE is down nearly 45% over the last 12 months. The software conglomerate that supports video, photo editing, app development workflows, PDFs, and many other programs for the creative industry has faced growing concerns about AI disruption. The stock's average price target is $429 compared with its current price of $258. The idea is that marketing agencies or small developer teams can occupy Adobe's product suite, platform integrations, and decades of software development by simply asking an AI bot to replicate it. While investors should not underestimate the growing capabilities of chatbots like Claude, this feels unlikely. A group of marketers does not want to spend time building video editing software, so they pay Adobe a small subscription fee each year. Yeah. And you think Adobe's not just like doing its own AI stuff? I mean, come on, bro. Other startups such as Figma or Canva are the real competitive threats to Adobe. Both have grown in recent years and encroached on Adobe's product turf. However, so far it looks like Adobe can still grow through this increased competitive pressure. Last quarter, the business posted record revenue of $6.2 billion, a large backlog, and began buying back shares at a discount. Whoa. All right. Adobe's revenue has consistently grown for the last 10 years and should keep growing as the company raises prices on its software subscriptions while adding new customers. The stock trades at just 12.5% or 12 gosh. The stock trades at just 12.5x trailing operating earnings, which is one of its lowest levels ever, making it an ideal time to scoop up some shares. Adobe? There's a little chart here, guys. The heck? I don't know what that was. Sorry. Is AI disruption real? It's real enough. Is AI disruption real? It may be easier for a group of software developers to build competing products to Wix or Adobe than it was a few years ago, but this does not mean customers will automatically switch to new programs over systems they have trusted to run their businesses for decades. You're taking a major risk by porting over your entire operating system to a software program built by AI when existing solutions from Wix, Adobe, or any other trusted software already work for you. The idea that small business owners paying for a Wix website or teams of marketers using Adobe will somehow vibe code replacement platforms and churn off these software programs is laughable. AI disruption is a real risk to the entire business world, but it doesn't mean existing software programs will die tomorrow, or that everyone will spend their days using AI chatbots to code software replacements. Yeah, I don't know. I guess it's possible, but Yeah. Don't let the headlines and falling share prices scare you. Now is a great time to buy the dip on Adobe and Wix.com. Should you buy stock in Wix.com right now? Before you buy stock in Wix.com, consider this. Guys, this is not financial advice. Good grief, these people. The Motley Fool Stock Advisor analyst team just identified what they believe are the 10 best stocks for investors to buy right now, and Wix.com wasn't one of them. The 10 stocks that made the cut could produce monster returns in the coming years. Consider when Netflix made this list on December 17th, 2004. If you invested $1,000 at the time of our recommendation, you'd have... Alright, fuck that. Okay. Alright. That's pretty cool. Have a look at these cryptos. We got Bitcoin sitting here at, I mean, it's just, I'll be real with you now that we're kind of getting towards the end of the video. I think Bitcoin's due for another leg down. I think that's going to happen. I think it's going to go down again. And people are going to be crying and screaming. You got to get to maximum devastation. That's what I've always seen happen before, you know what I mean? Maximum devastation. That's what it requires. Okay, so I think that's going to be enough for today. What did we find? Well, we found that some of them are way low value, and some of them are, you know, their PE ratios are getting way out of whack because of, it seems like because of their, like, AI spending and stuff like that, maybe. So, you know, you got to find the ones with the value, I guess, but, like, it seems like even the ones with the wacky PE ratios, their analyst consensus are that they're gonna rise in value. So, I don't know. In my opinion, Adobe's probably the best buy of them all. I mean, if I had to pick one, you know. But yeah, I think that's going to be enough for today, guys. That was a lot of fun. It's your cousin Dustin. If you guys ever want me to try to dive into some stocks, you know, let me know. We'll give it a go.